Welcome to e-learning platform of Kadi Visvyadhyalaya. I, Professor Uday Vaidya, would like to introduce a new concept, fixed overhead variance from standard costing. Fixed overhead variance. Fixed overhead variance arises when a company uses absorption standard costing system. Under this system, a standard rate is developed for fixed overhead by dividing the total fixed overhead by a suitable base like labor, machine hour and numbers of units, etc. Fixed overhead incurred differ from standard allowance for fixed overhead or standard fixed overhead for a production for various reasons. Fixed overhead variance are bifurcated in two parts, in which number 1 known as the expenditure or budget variance, where number 2 known as a volume variance. Volume variance furtherly bifurcated in three parts: calendar variance, capacity variance and efficiency variance. Expenditure or budget variance. It represents the amount of fixed overhead which should be spent according to budget or standard during the period. The amount is predetermined for finding out the fixed overhead rate for related period. The amount of standard allowance for fixed overhead does not change due to change in volume. Calendar variance. The related period may be given in terms of days and hours. The value of this days is found out by multiplying days and hours available and standard overhead rates. Capacity variance. In actual working condition, our work and hour available during the period may be different due to strike. Therefore, value of this variance can be determined by multiplying actual work and standard rate. Efficiency variance. It is arrived at by multiplying the actual production and standard rate. The standard fixed overhead for a production can be found out by unity method. Actual production in unit multiplied by standard fixed overhead rate. Hour method. Actual production in standard hour multiply with standard fixed overhead rate per hour. FOAR. It is very important element for calculating practical sum. FOAR is known as a fixed overhead absorption rate. Formula for FOAR is standard fixed overhead divided by standard hours for standard output. Now, the slides help to you for calculating a practical sum of this topic. Whenever we are calculating a practical sum of this topic, we are prepared a 5 column in which number 1 indicate as an actual expenditure, number 2 indicate as a budgeted expenditure, number 3 indicate as a revised budgeted expenditure, number 4 indicate as the actual hour into fixed overhead absorption rate, number 5 known as a standard hour into fixed overhead absorption rate. Now, whenever we are calculating a efficiency variance, we are calculate standard hours into fixed overhead absorption rate, which is our last column, minus column number 4, which is second last, actual hour into fixed overhead absorption rate. We get efficiency variance. If I want to calculate revised capacity variance, at the time column number 4 minus column number 3 means actual hour into fixed overhead absorption rate minus revised budgeted expenditure. And if I want to calculate calendar variance, at the time I want to doing column number 3 minus column number 2 means revised budgeted expenditure minus budgeted expenditure. And if I want to calculate expenditure variance, at the time I am doing column number 2 minus column number 1. Now, we already know that capacity variance is a combination of calendar variance and revised capacity variance. Means whenever we are calculating a capacity variance at the time we are doing summation of calendar variance and revised capacity variance. And we are also knowing that volume variance is a combination of capacity variance and efficiency variance. Means whenever we want to calculate volume variance, we are adding capacity variance in efficiency variance. And it is a common result whenever we are calculating fixed overhead cost variance, we are added expenditure variance in volume variance. Thank you.